Welcome everyone to the Kendall Report, where I share my 40 years of experience to help you manage your portfolios and protect your wealth. Remember to subscribe, like, and share these videos. Yesterday's market action, we saw a very lackluster trade for most of the session until the last 2 hours, where mass liquidation came in ahead of the FOMC meeting today. While the markets will be focused on the FOMC meeting, there's also a ton of earnings reports to come out before and after the close on Wednesday, and many substantial companies that are likely to have a material effect on the markets. But Jay Powell and the Fed will put their best foot forward, trying to demonstrate to the markets that they've got all the facilities in place to support the economy. The reality is they probably don't, but they're certainly going to do everything they can to convince market participants that they do. I discussed a couple of days ago, if they passed a new stimulus bill, that the Fed would try to match them in some manner. It appears unlikely, at least for this week, and maybe who knows how long, that stimulus bill will be in limbo. The Fed, they may lead the way, extending a program, adding some more support into areas that they see risk, and there's plenty of them. As we all know, there's a massive amount of the economy absolutely disrupted, and there's nothing good going on a big scheme of things. We're probably running at 40, maybe 50% if we're lucky. Obviously, the hospitality and travel and several other elements of the economy are completely destroyed and are not even coming close to coming back. Not only do we have to worry about what's coming out today, the next 3 days are going to be very material. I talked to you on Monday's video that I believe this was going to be one of the most intense weeks since the economy's opened back up. After the close on Wednesday, as I mentioned, we're going to have a ton of earnings reports that come out. On Thursday, there's significant reports coming out before the open. We also have the unemployment claims coming out, expected to show another increase. And once again, those continuing claims are going to be what to watch closely to see how many people remain unemployed. But then after the close on Thursday is the big one. We have Amazon, Apple, Google, and several other major players to report after the close on Thursday. This is going to set the tone for plenty of volatility as we come into Friday's open. One of the things I'm beginning to see is the short-term database is starting to roll over. My expectation is to see a massive rollover, otherwise a ton of sell signals come in over the next several weeks. A healthy thing to happen for the market would be for that database to go from 85% bullish down to 45 or even below 40%. I think we could be at that point in the market's development that that's going to happen. This would suggest there's some downside risk that is building. The probabilities are building substantially. We're looking at a trade that we've had on very close to a sell signal or an exit being triggered. So there's a lot of elements coming into this window of time. And it's going to be very critical how we close over the next several sessions. In conclusion, the probabilities are starting to build for a minor sell-off. I still have some key numbers below the markets that I believe will hold, but we are going to see some definite further consolidation that I've been talking about. It's just a matter if the consolidation ends up to be a material sell-off that reacts within the market grid on the weekly or even the monthly charts. Let's go ahead and take a look at the charts and see what they're telling us. Looking at the WaveTech database, we did see about 450 sell signals come out of the database, moving the percent bullish on a short-term models down to 85.31. In the opening comments, I mentioned that I believe we're about to go into a downward rotation. This is likely to unfold over the next 4, 6, as many as 8 weeks. And once we get through this rotation, then we will start to see a stabilization of the database somewhere between a minimum of 55% to the extreme to around 35%. In that range will be where this database will ultimately bottom out. Now, that recycling will be very healthy for the markets, setting up the tone for a next leg to the upside. The question is, if this liquidation occurs, how deep will the markets correct? Right now, the expectation is to stay in a broad trading range, and I'll discuss that here in just a few minutes when we go through the charts. But the database is suggesting that there is the beginning signs of a rollover, and this is likely to set the tone for the next several weeks. From an intermediate viewpoint, database is at 65.38%. If this liquidation occurs on the short-term database, there will be some backfilling, but not very much. The trades on these models will typically hold about 206 days, and these are trading days, so the better part of a year, there's about 220 plus days in a trading year. These trades are likely to stay on in spite of any rotation and some backfilling in the markets, as long as it doesn't become material and stays within the ranges that I'll discuss in the charts here next. As I discussed in the opening comments, we're likely to see this trade that came in on May 5th at 28.47 on the futures. This is very close to being liquidated. We still have some upward projections that are valid. The close below 31.86 will trigger this trade to exit, suggesting that we would see a further decline to around the 31.44 to the 31.30 level. The key chart here to watch is going to be the weekly graph, and looking to the 10-week moving average to be tested, which is currently at the 31.23 level. That's about a 100-point decline, and with the PPM still up at a 0.88, this suggests that there's only a 20% probability for the S&P to decline below this level. Now, we are starting to see on a weekly basis some loss of momentum. You can see that PPM1 is turned down, and this is likely to continue, but as long as it stays above that 0.25 level, that 10-period moving average is going to supply substantial support. My expectations, as I just discussed in talking about the database, if this market moves down to that level, we're likely to see a lot of these trades roll over on a short-term basis and start to move that database back into the range that I talked about. The downward risk below this level would suggest that a decline toward the 3,030 level would occur. I don't see that happening in the current configuration. Expectation is for it to stay within this market grid on a weekly basis. Right now, it is a broad range of upside 32.99, and on the downside, we're looking at as low as 31.08. 3 is the 31.30 level. That's the extreme support at this time. As we complete the month of July, we're likely to see this continuation of this contraction of this range on a weekly basis. One of the things I've been noticing over the past 2 weeks is that markets are starting to normalize, and we're seeing volume creep back towards that 4 billion mark. We're at 5.3 billion yesterday. We're continuing to see a stability in the markets in a tight range. Unless there's some big spike in volatility, this is likely to continue to be the pattern. Right now, we've got about an 18 to 20 handle range projected every day. Yesterday's range was about 17 handles. So this is becoming normal. And going back before all of the volatility and before the collapse of the markets, we would see about a 14 handle average range. We're back to a normal markets, and you're seeing the frenzy that was out on the internet around the markets really start to dissipate as well. Maybe it's complacency, whatever it is. There is definitely a slowing down of volume and activity. Folks are starting to get a little bit bored. Now, the one thing that is probably going to support this market at these levels that I've talked about, are the talking heads are everywhere telling you that there's a bubble and nothing's going to collapse when everybody's telling you it's likely to collapse. But these numbers that I'm talking about here are very substantial. The trend on a weekly basis is very firm, and a decline below that 31.23 level is very unlikely in this current configuration. Now, going to the NASDAQ futures, this is something I started talking about last week. We're still seeing a range set up here. We spiked out at just above 11,000. So about 3 weeks ago, I had a projection of 11,000 on the NASDAQ. We went to 11,058 2 weeks ago. And since then, we've been just waffling in this sideways range, drifting lower for the most part. Last week, we closed lower. We're slightly higher than Friday's close right now, but we've got a lot ahead of us, as I discussed in the commentary in the beginning. But once again, we're seeing dissipation of PPM1 is turned down. PPM2 is flattened out, even though it's at a very robust level. And PPM3 has also been moving lower over the last couple of weeks. So we're seeing momentum come out of this market, but there's enough momentum that tells us that we're going to lock into this trading range, which will be dominated by this market grid going forward. And the other thing that has happened is the market grid is flattened out. Typically, when it does that, you'll see anywhere from 3 to 4 weeks that trades within that range. Next market to look at is gold. Last night's thumbnail said gold and silver tops. I believe they probably did put a short-term top. I don't think it is the top. I saw a lot of comments telling me I'm wrong. I'm telling you that this thing is going to stall out here. The same thing that I was just showing you in the NASDAQ. The market grid is squared off, and the big spike in prices that happened over the last couple of days, it's more evident on the weekly chart, which I'll show you here in a minute, is telling us that this broad sideways range is going to continue. PPMs 1, 2, and 3 all in trend level. So the underlying trend is huge. The support 1886, but that's coming up every day, about $10. So we'll be at the 1900 level very quickly. And one of the other elements that I talked about yesterday is we needed to close lower on the session. We did manage to close higher. We're up about almost 0.5% tonight, trading 1972. The high has been 76, the low 63, so it's a pretty quiet evening session. We're not likely to trade above the R2 number, which is 1987. 1952 is S1, so we'll probably see an S1 R2 number at best for the range for today. But looking at the weekly graph, this is where the story is being told. We managed to trade above the weekly extreme in yesterday's action. That was 1987. We saw a high of 2000 this week, and this is a very robust trend. We've got all the PPMs, PPM1 plus 1.15, 0.73, and 0.63. Anything over 0.25 is an uptrend. These are 3 and 4 times the uptrend level that tells us that there's a uptrend. The support numbers basis the moving averages are way below this. So once again, the grid will dominate. We see S1 at 1910. The low this week has been 1926. We could see that retested, but there's some firmness overnight, what we're seeing right now, and market is likely to stay in this range. And notice, just like in the daily, the weekly has also got a square pattern, which suggests a sideways trading range. And this is what I was talking about in last evening's market commentary, is that I believe that short term we have topped out. Longer term objectives, you can see on the screen, I talked about these the other night, are still for a move to 2134 to 2200 on gold. So there's going to be some consolidation here. I think we got a little ahead of ourselves with this last explosion, especially with everybody that's been calling for a rally in gold, bragging about it. We just got to the extreme of this particular sequence. The last market we'll look at tonight is silver, and yesterday's range in silver just blew up. It was a crazy number. We saw the range of 26.27 and a low of 22.46, a $4 range. We closed at 24.30. We did close higher. I mentioned that a lower close would be significant. Both gold and silver have gotten into this volatility range. It's going to start to go into sideways range. Notice PPMs are still positive, but they're starting to lose momentum. And this is the first signs of going into a trading range. And we're likely just to stay within this grid right now. For today's action, the grid on the silver is the extreme of $22 to $25.90. So far, the high has been $24.63. That's just below R1, which is 24.80, and the low has been 24.15, and S1 is 23.80. So best case here today, S1, R2, there's definitely a lot of upside momentum, most likely a top similar to what we saw in Tesla several weeks ago when we got that big blow up and went screaming to the upside, and then we set up this sideways pattern. So the key support is going to be at that 22.32 level, which was where we traded down to yesterday. We traded down to 22.46. Expect this market to go into a sideways consolidation. It should last for at least 3 to 5 sessions, and then possibly we can start to move out of this range. And I'll continue to cover these markets since they're so hot at this time. This is the end of the video. Thank you for watching. Remember, we have the live cast tomorrow at 1:30 Eastern Time. Usually goes for 2 to 3 hours. We'll get to watch the Fed actually make their announcement and talk real time about the reaction to the Fed statement. Thanks again for watching. We'll see you tomorrow at the live stream.